Many thanks for, by the way, joining this webinar today. We are going to cover the market environment. We're going to look into market trends, share content, discuss market prospects, and hopefully we can have a very interesting Q&A session. For those who do not know me yet, I'm Block Asset Management's Chief Investment Officer. I'm based in Luxembourg. We launched in 2017 our fund of fund strategy. We're supervised by the CSSF, which is the Luxembourgish regulator. And actually, we're very pleased to share information today. And hopefully, we can learn stuff and have an interesting discussion. All right, I think that we can start now. I'm going to share a presentation. So yeah, let's start with the market update. So yes, we've heard a lot of noise about Bitcoins, altcoins decline last month, but I think it's very important to keep in mind that this year again, digital assets have been the best asset class compared to equities, fixed income, gold. It's been, by the way, the case 10 times in the last 13 years. So yes, in spite of April's and May's correction, it's still a very good year for digital assets. Of course, we had these 2 periods of time this year. The first quarter was very bullish, very good. Ethereum outperformed Bitcoin. Some altcoins did outperform too Bitcoin. But then we started a mild correction, which unfortunately translated into a bigger correction with the broader market. If you look at the purple color on the chart, with the market X top 10 underperforming significantly Bitcoin, which turned out to be then the outperformer during the correction. This was due to a combination of factors, probably too much optimism in the short term, a lot of open interest in the futures market, the disappointment regarding the US CPI, and the SEC is sending a notice to Uniswap, questioning Uniswap's business with potentially legal issues going forward. So all this caused a big sell-off, and the DeFi sector was particularly hit and massively oversold with names like Uniswap, SushiSwap, Aave, Curve being hit very hard with a 50% haircut. All the gains locked during the first quarter were gone as a result. In terms of what worked and what did not work this year, meme coins, AI plays, web infra, DePIN plays, they all performed very well, significantly outperforming Bitcoin. And on the other hand, some well-known names like Cardano, Polygon, Polkadot did not so well, even having a negative return. So a two-sided market with the meme coins, not supposed to have a lot of intrinsic value, actually doing much better. I think that there were different, very interesting developments this year. The fact that Bitcoin's ecosystem is expanding, the launch of the Runes protocol on Bitcoin's after Bitcoin's halving was, I think, a major innovation because Runes is going to allow people to create tokens on top of Bitcoin. So using Bitcoin's infrastructure, and Runes works with besides with the Lightning Network Protocol, the L2. So overall, it's a very promising, and this could actually help help the Bitcoin's network have a lot of transactions going forward, and it's very important for miners, for example, as we know that with the halving, their profitability has been cut, and therefore transaction fees going forward might increase for Bitcoin miners, and this might help avoid having Bitcoin miners selling their Bitcoins on the market. So it's so we're also considering with this new technology, Bitcoin DeFi solutions, a lot of meme coins being launched. So much more activity going forward. So the Bitcoin is not going to be just a store of value, but we are having a significant innovation here with the potentially with the rules protocol. So it remains to be seen if this is going to get traction or not. But technology-wise, it brings some innovation. Then, of course, we had the rise of Ethereum's layer 2s, currently having a TVL around $38 billion. So the TVL tripled on a year basis. So this is really significant growth. And with Ethereum's Dencun upgrade, you're going to have a decrease of transaction costs on Ethereum because L2 batches are going to use the blobs functionality, which is reducing the size being stored on the Ethereum network after I think it's around 2 weeks. It's not the exact number of days, but after a period of time, the information is deleted. So it's an upgrade which is going to help all the solutions scale, and this will bode very well for the Ethereum's ecosystem. Then the third big innovation and trend is Eigenlayer, which is Ethereum's restaking solution. So it's very innovative in the sense that contrary to staking, where of course you're going to lock your token for a certain period on a protocol, with Eigenlayer you're going to be able to restake, so to stake in different security pools your tokens. So therefore you can increase your yield, and it's very helpful for developers who can focus on working on functionalities, on dApps, without having to work on a security pool. They can already use available resources through the Eigenlayer protocol. So it's a very big innovation, and it's still very early stage, but the protocol has managed to attract $40 billion in TVL, so it shows the interest. Then maybe the fourth topic of interest is the tokenization of real world assets, with of course BlackRock's money market fund being a success and allowing to actually tokenize the bond market through this money market fund. So the trend that we can see with the Ondo is and those likes is, in my opinion, a trend towards more and more assets being tokenized, and this is very good for blockchain because it's going to generate a lot of activity. Investment-wise, we had the BTC ETH spot ETF approved in Hong Kong. So again, very positive sign that digital assets are being endorsed. Adoption is progressing, and of course, we are all expecting the SEC to approve a spot ETF for Ethereum sometime this year. So there was a decision postponed for the Invesco Grayscale ETF recently. But so then now we are expecting mid-June for the next ones. It might be the same game than for the Bitcoin's spot ETF approval. It will take time. There might be some delays, but at some point we expect this spot ETF for Ethereum to be approved. Another interesting topic is the ESMA the ESMA called for evidence on UCITS. So it could be that at some point in the future, UCITS are allowed to invest either directly or indirectly into digital assets, which would then open a very big market, a very big pool of potential investments to the asset class. So very interesting developments for, this year. Now, it's true also that volatility has returned this year, and we shouldn't be surprised because the rally is stalled at key retracement levels, and this is not unusual. It happens in the last cycle, and it's quite normal to have some sort of retracement, as you can see. For now, we're just experiencing a very old-fashioned ABC correction, which is a corrective pattern, which allows the market to digest the gains and maybe the overbought situation created by the last upwards move. So we're expecting this correction to be followed by a resumption of the bullish trend. And when looking at the primary trend, the long-term trend indicators, they're all positive for Bitcoin, the total market cap ex Bitcoin, even DeFi. So the message is that we don't see any reason to change our stance. The primary trend is still up. So from an investment perspective, not a trading perspective, from an investment perspective, the path of least resistance is upwards, and investors should remain invested. When looking at some basic risk management indicators, again, the same message. We are not at all in red territory. So it's not the time to play defense. Now, when using some of our checklist indicators, the first one is, of course, macro. Bitcoin is increasingly a macro play. So inflation, interest rates are significant inputs for Bitcoin's price expectation. So as you can see, the blue line, which shows the CPI, the green line shows the core CPI. We are now in the process of reverting to the long-term trend. Not there yet. So as you can see, the blue line, total CPI, has not declined as much as the core CPI. There was a bad surprise on the CPI data at 3.5%, a bit higher than expected. But this is the reason why the Fed is on hold now. They want a little bit of a reassurance that indeed the CPI is going to continue to decline and revert to the long-term to its long-term trending range. So overall, we're considering actually a bullish situation for digital assets, which is a gradual monetary easing with maybe a first cut after the summer and potentially a second one in early January 2025. So nothing to be worried of. The reason is if you look at periods of aggressive cut rates, it's not a good sign. It's usually not a good omen for digital assets because it's usually means that there is something wrong with the economy, with a number of factors. So the last thing that you want to have is the Fed cutting rates aggressively. So a gradual easing is the best possible outcome, and this is the situation we have for now. Okay, so this is a metric everyone has been following until now. Yes, indeed, the Bitcoin spot ETF in the US has been driving the Bitcoin price higher with a lot of positive net inflows, more than $10 billion. So this is very significant, and it's true that lately the net inflows have been mixed, to say the least. And they have not been supportive. So this is something to follow, but the long-term trend is still there, so there's no reason to be overly pessimistic about this. Something I think quite interesting is a disconnect between USDT growth, which is the number one stable coin, and we tend to see USDT as a little bit the gateway to a digital asset. So the more supply you have, the more likely you are to have liquidity pouring into digital assets, and there is a nice correlation between USDT growth and periods of USDT growth and the total market growth. We've seen a disconnect since last March. USDT growth is plateauing a little bit now, but at some point we should have a reconnection, and we believe that the reconnection will be will be resolved through higher prices on Bitcoin and digital assets. Another item in our checklist is of course, Bitcoin's dominance versus the altcoin's dominance. We are still waiting for Bitcoin's dominance to decline. The moment you're in such a period, you know that you have to be very careful because it's usually the last stage of the bull market. So there is no red flag in that respect, and so this means that the big upside, in our opinion, is still ahead. Another item in our checklist is just U.S. technology, U.S. equities. We know that on a correlation basis, it's going to be very difficult for Bitcoin digital assets to perform nicely if we enter a severe bear market in equities. It's not the case now. So again, no red flag. Now, in terms of performance review for our investors, we had a nice, so the performance has not been updated as of end of April. We are still waiting for our NAV to be calculated, but we're, so as of end of March, we were around 50% net return year to date. The last 6 months have been great, I have to say. It's a triple-digit return, but of course, April is going to be down. Our assessment is that we are going to be around 23% down in April, so in line with the CCI 30. In terms of asset allocation, we've been, as you can see, in dark blue and light blue. You can see our PEVC and trading strategy, which are higher beta strategies. They've been massively overweighted, and for good reasons. We were right on our tactical asset allocation. We decreased cash, we decreased fixed income strategies, and we plan to remain overweighted higher beta strategies at least till the remainder of the year. If you want to have an idea as to what are our holdings, so applying a look through on the top 5 positions by fund, you can see that we are not a Bitcoin fund. We invest in funds having a broad diversification, and we invest in altcoins. Some of them are very well known: Solana, Filecoin, Chainlink, Stacks, Render, Polygon, and many others. In terms of performance contribution, our higher beta funds have been delivering, that's for sure. With PEVC and trading long-only fundamental strategies delivering an average performance around 60 and 74%, 75%. Or systematic quant funds have been struggling a little bit, and or fixed income, as the strategy is supposed to be deliver a very low return, but it's normal. Overall, our strategy has been in line with the market, and they're doing in some occasions even better. So far so good. And now, in terms of market outlook, particularly given the correction we had so far, I know that there is some uncertainty, and some investors are asking us, but is this the start of a new bear cycle? Is this over? Are we done? Should we reduce our allocation? So we're not investment advisors, but in terms of what we think about the market for the fund, first of all, we believe that yes, for Bitcoin, we're getting into the late part of the cycle, looking at the BDD multiple indicator, which is in a few words an indicator which shows when long-term holders, Bitcoin holders, start to sell their holdings. So you can see that we had a spike recently, and usually when you start to have those spikes, you're entering a sort of trading range, and you're getting increasingly near the end of the cycle. Not there yet, but this indicator means, at least in our opinion, that we're probably there will be more limited gains ahead for Bitcoin. This is somehow confirmed by another interesting indicator, the CPI index, which is a composite of various measures, indicators on-chain or price-related on Bitcoin. You can see that we had a spike. We were a first spike recently, actually aligned with the Bitcoin stop this year. It doesn't mean that this is the market top. It's just another red flag for Bitcoin, basically saying that you're entering a moment when you most probably gains are going not only to be limited, but you're not anymore at the start of the cycle. And we're still expecting a spike towards the 80 to 90% level. So not there yet, but this means that the focus, in our opinion, shouldn't be on Bitcoin at this stage of the cycle. Here you can see that indeed we've been roughly around 36 months, 3 years, also to revert to the previous market high. So that's what we did on Bitcoin. And we're, as you can see, in terms of cycle analysis, well advanced in the cycle. So we're targeting 100,000 to 150,000 at best target for Bitcoin for this cycle. Now, the good news, our focus is on the broader market, and for good reasons. As you can see, we had, and this is the sign of strength cycle circle, sorry, here. After an accumulation period, we had a nice rally and then a correction. And this is very similar to actually what happened in the last cycle and what tends to happen in digital asset cycles. So we are quite late in the cycle compared to Bitcoin. And therefore, we believe that after we complete the current consolidation period, we should enter into expansion, not retracement, expansion. So that's really what we need to see. We need to see expansion. We need to break certain levels to really have the broader market outperforming Bitcoin. Interesting to see that during the last cycle, between December 2020 and November 2021, the market X sub 10 did a 5x return, and Bitcoin only doubled. So this is consistent with our 100,000 to 150,000 target on Bitcoin. We're not expecting much more than this, and we think that the big opportunity is on the broader market. In terms of Elliott wave analysis, so it's always tough to get the wave right, but if we look at the market dynamics and the fact that we're in the middle of the cycle, based on this analysis, we can see the current ABC correction, and then we should have another wave upwards with a strong acceleration. Of course, if we go, the point here is to understand that if the current correction goes below a certain level or gets huge, then this scenario is off, and we should think about another scenario. It's not the case for now. It's quite interesting to see a very short term that the current consolidation is very similar to the market. This is a total market cap, to the January to February 2021 fractal. It's a typical consolidation. You want to, in the short term, the market to climb above the yellow box, maybe retest it, and then move forward and move upwards. Then in this case, I think that the odds are very high to have the start of a very big rally. If not the case, then maybe we have another 10% drop, which is still okay. It's still okay as long as we don't decline much more than much below the red box. Another scenario might be a prolonged consolidation like what we had in 2023. So we've been, if you look at in terms of duration, the current correction is very similar to the one we had in 2023. So we'll have to see if indeed we need a little bit more of time to work out this current consolidation phase or not. But we think that here the question is, are we going to rally now, or maybe it would be the case in September? In both cases, our opinion is that it's still a bull market, and we're headed towards much higher levels for altcoins. So, quick conclusion. So we are expecting the current correction to be only a technical retracement and not a new bear market. We expect more of a risk-on environment, increased liquidity later this year with a market expansion. We, of course, think that based on those indicators that the broader market is going to outperform Bitcoin, and that the best strategies are going to remain PEVC trading strategies with a focus on very strong market trends like IA, DeFi, decentralized infrastructure, tokenization of real world assets, all those things. So we plan to remain fully invested, and we will continue to work on what we believe is so important in digital assets, due diligence, and continuing to find the best managers in this space. All right. So I think that now we could open the question and answers session. So I have a first question. Can you explain why Bitcoin long-term holders start selling is a bearish indicator? Yeah, okay. So usually long-term holders are considered to be smart investors. They tend to sell not at the market tops, but when after Bitcoin has experienced already a bull market. So it's a nice indicator to see. It's an interesting indicator. It's one amongst many others, but it's essentially because they are considered smart money. Now, question two. Equity markets usually have low volatility in summer months. Do you expect similar behavior for crypto markets? I mean, if we don't break to the upside very soon, the current consolidation pattern we're in that I've shared with you, it's quite likely that we are going to enter some sort of a broad trading range, sideways trading with the occasional spike, and most probably the best action will be to do nothing and just wait and wait for the market to break out at some point later this year. So we might have some low volatility, but keep in mind that for cryptos, digital assets, we very often have occasional spikes and false signals to the upsides and the downside. How often do you get valuations for the PE and VC exposure? We get those valuations on a monthly basis, but of course they have a valuation policy and don't and reevaluate their holdings depending on the situation. If there is for example, a new token launch, or if they just keep their holdings at accounting value. But we have a monthly liquidity on those funds. They invest in illiquid investments in the sense that they don't have a short-term liquidity, and then they have to wait for a number of quarters. But also in smaller cap projects, which in any case, we're expecting those PEVC funds that we have in portfolio to really do exits later this year. If it's not the case, it means that they cannot do the exits that they're supposed to do. So in both cases, we believe that end of this year, we will either have very nice returns, or we should actually change the strategy and do something else. How do you find managers? Do they reach out, or do you reach out to them? What's your decision process to add a manager? Very good question. So it's a combination. We use an internal database. So we have hundreds of funds that we find doing our own research, subscribing into database, paying for it. And we also receive requests from managers. So it's and the idea is that we have four main strategies. We have higher beta strategies like PEVC trading, which are subdivided into long only fundamental and quantitative systematic. Then we have beta passive strategies and fixed income strategies, which are lending funds, for example. And for each of those main strategies, we then set up a watch list of funds which meet certain quantitative and qualitative criteria, and then we can perform a due diligence, which is a very extensive process for us, because it's not just sending a due diligence questionnaire. We really work with those managers to understand what is their diversification in terms of counterparties, custody arrangements. We want to understand all those risks and make sure that they are properly diversified. Then once we have passed the due diligence process, then we're going to potentially add a fund in a portfolio context. So we have a tactical asset allocation. At the moment, we are high risk, higher risk than average, if you want, overweighting PEVC and trading strategies. So we're going to focus on those strategies, and we will try as much as possible to decorrelate returns, adding, for example, for the trading strategies, managers having a different approach so that we can decorrelate as much as possible, even if it's difficult. How many funds holdings do you have in average in your fund? We have between 15 to 20 funds. It sounds like VC funds are not doing as well as liquid funds going forward. Yes and no. It depends on which VC funds. It is true that some of them have bought into very high valuations during the life cycle, so it's quite difficult to do the juicy exits now. And I think that also investors are increasingly reluctant to buy a project for 2 billion, 3 billion valuations, which is very early stage. Because then the upside is going forward is limited. So yes, it depends on the VC funds. Then what is the level of assets under management now? It's close to $20 million. How do people reach out to you? They can contact us through email. We are also on LinkedIn, so we are very open to discuss what we do and to look into new funds. Can you explain your diversification approach and also how you ensure it on the different fronts? Okay, I think it's a very important topic, and this is maybe the reason why we're here, actually. We all understand the concept of diversification. Don't put all your eggs into the same basket, but we think that we need to go a step further, and we should actually consider the true diversification, which is not only spreading your investments in a portfolio, different assets, different funds. It's really looking into those funds and understanding the underlying risks, because you might have one fund investing in fund one and fund three investing in the same exchange, for example. So then you add up the risks, and you might think that on surface that your counterparty risk is diversified, but it's not. It's not the case. So this is our job, to make sure that we really diversify the underlying risks, doing this monitoring, regular monitoring of those funds, and the due diligence. Yeah. I don't think we have other questions. All right. So thank you very much for your attention. I hope you had a great time, and this webinar session was useful to you. And let's stay in touch, and have a nice day. Bye.